Hey everyone, it's Rich Warner from the Smart Investor Models YouTube channel. As part of the Antifragile Investor series, this video is about how to safely invest your hard-earned cash and beat CDs and money market yields using short-term bond ETFs. At the end of this video, you'll have an efficient short-term allocation to ultra-conservative safe bond ETFs that you can use to generate interest safely, beating the yields on CDs and money market accounts, as well as high yield savings accounts, without sacrificing any liquidity. I'm going to show you how to do that. You struggle to make ends meet and set aside some savings so you can attain some of your biggest dreams, buying a home, having a family, living comfortably, paying for a child's education, saving for retirement. There may also be an unexpected car repair or medical expense, replacing a major appliance in the home, or paying off loans, whether it be credit card debt, car loans, or mortgages. The point is that you have a set of short-term immediate expenses that you need to build a reservoir of capital to help pay for them. We've all been there. So the question is, how are you going to invest all that hard-earned cash that you managed to set aside at the end of every month? We're absolutely not talking about one of those holy grail get-rich-quick schemes here. You may also have gotten burned by buying that meme stock that Uncle Eddie recommended at a recent Thanksgiving dinner, only to find that after you get in at the top, it's already maxed out and it's headed for a 50% correction. The stock market itself has presented some scary moments in financial history. If we go back to the 1930s, of course, the Great Depression years, the U.S. stock market index suffered an 85% pullback, and it took almost 30 years for the U.S. stock market index to recoup its losses from that severe crash. Then there was a 73% drop between 1966 and 1982, and it took 29 years to recover from that drop. And more recently, we've seen drops on the order of 46%, 50% drop from the tech bubble burst in 2000. The great financial crisis also presented challenges. The point is that if recovery times can take as long as 3 decades if you're 100% invested in stocks, you're not going to use a stock investment account to meet your immediate financial expenses. And you may find yourself asking whether all this investment stuff is even right for you. Just leave it to the pros, right? Not necessarily. I'm here to tell you that a lot of serious money is not even invested in the stock market at all. Global bonds have over $141 trillion outstanding in debt issued by federal governments, municipal governments, and corporations. In comparison, the global market capitalization of stocks worldwide is $127 trillion. So the bond market is actually $14 trillion larger than the combined value of all the stocks in the world. And in the United States, about $56 trillion is invested in bonds versus $54 trillion invested in stocks. So it's a little bit closer in the United States. But if we look at it on a global scale, the bond market is indeed much larger than stock markets worldwide. And did you know that the average investment grade bond is much safer than the S&P 500. The aggregate bond index, AGG bond ETF, for example, is about 33%, 1/3 less volatile than the stock market. And the short-term bond ETFs that I like to talk about in this video are actually 5% or 1/20th the risk level of the US stock market. So we're talking about a significantly safer investment approach when it comes to short-term bond investing. Indeed, if we take a look at this chart here, we've got the DFA 1-year fixed income portfolio, which is comprised of treasury bills, short-term investment grade bonds issued by very safe companies, and investment grade securitized loans. That's the red line. DFIHX is the mutual fund in this case that is comprised of pretty much the same securities that I'm going to talk about in the bond ETFs. But if you look at the red line versus the blue line, which is the US stock market, you'll notice that the tech bubble of 2000 to 2002 saw stocks drop actually more than 50% over that time span. And then again, we saw a 57% drop in the great financial crisis of 2008, 2009. Meanwhile, as you can see from the chart, the red line didn't suffer any volatility at all. it was smooth sailing throughout both crises. Point being, once again, that short-term investment-grade bonds are much safer than stocks, and they're a great place to keep your serious money, the money that you need to pay for immediate expenses. Recent monetary policy by the Federal Reserve has also helped short-term bond investors, because if the Fed raises short-term interest rates as they did to combat inflation after the COVID crisis, that actually helped short-term bond investors because it raised the yields. And monetary policy these days is still quite restrictive by historical standards, so there's some decent yields available for short-term bond investors. Now, if we take a look at this chart here, we see that short-term bond ETFs beat treasury bills, money market accounts, and high-yield savings accounts over time. And as we can see from this chart, the short-term bond ETFs outperformed treasury bills and money market accounts quite handily. A $10,000 investment in the early 1980s would have generated a portfolio end value of almost $29,000 versus only $14,000 for money market accounts and about $23,000 for one-year treasury bills. So we're talking about serious outperformance here without sacrificing liquidity. Now, if you stick around to the end of this video, I'm going to share with you my Model A2 portfolio in its entirety. This is a bucket A ultra-conservative short-term bond ETF model that I use myself that I find to be quite useful for most investors. So stick around for that. Indeed, in the Antifragile Investor course that I'm actually still putting together and should be available quite shortly, I share my complete list of bucket A models. I have 3 bucket A models that you can choose from. And as part of the Antifragile Investor course, you also get access to the rebalance spreadsheet, which you can use to help rebalance your portfolio periodically. Now, it's generally suggested that rebalancing a portfolio and asset allocation across your buckets A, B, and C, or buckets A and C, what have you, is generally done once a year, usually either at the very end of the year or at the start of the year. I like to think of this A list of bond ETFs as liquid money market funds on steroids. Now, these short-term bond ETF strategies are not as sexy as investing in stocks or option strategies, what have you, but investment-grade bonds are where the serious money is invested. And this includes money for endowments, insurance companies, pension funds, and a host of mutual funds and ETFs out there. Now, a question you may be asking yourself is, what is anti-fragile investing? What is anti-fragility? Now, anti-fragility derives from an investment book that was written by Nassim Taleb in a book called Antifragile: Things That Gain from Disorder. Now, you may have heard of Nassim Taleb as being the author of the Black Swan book, which talks about how outlier events are actually more common than most people expect. And a lot of this has to do with the way investors and analysts try to quantify risk. Indeed, Taleb's arsenal of books address the concept of the futility of trying to quantify risk based on past experience or data. Now, in terms of putting anti-fragility into practice for investors, we're basically talking about a serious chunk of capital being allocated to short-term, ultra-safe investments like these bond ETFs that we talked about. Now, in the Anti-Fragile book, Taleb suggests as much as 90% of your capital should be allocated to the safe stuff, and only about 10% should be allocated to hyper-aggressive strategies. So as part of being an anti-fragile investor, you should invest the bulk of your money in ultra-safe, low-duration investment-grade bond portfolios, which preserve capital and provide liquidity. At the other end of this barbell approach, we're talking serious aggressive growth strategies. We're talking about small and mid-cap and large-cap growth stocks. We're talking about venture capital. We're talking about call options and even future strategies. If you spread that 10% all over these risky investments, chances are some of them are really going to blow up in your favor, which is part of the pleasant surprise of black swan events. You know, black swan events are not only negative downside crashes, but they also include, intense bull rallies and things like that occur in various markets. So the basic idea is that you take this 10% bag of seeds, and chances are some of these seeds are going to really blossom and explode in your favor. It's really a schizophrenic investment strategy in this sense, this barbell, heavily weighted to the ultra safe and 10% to the ultra aggressive, and nothing in between, that Taleb says is the right approach for most investors. Now, before we move on, I'd like to ask you to take a moment to review the mandatory regulatory disclaimer statement. You know, I designed this anti-fragile course for everyday investors. Key concepts that I cover in the Anti-Fragile Investor course include: what is an ETF? How does it differ from CDs, money market accounts, high yield savings accounts, and stock and mutual funds? How do bonds differ from stocks? And how does ETF investing differ from trying to construct portfolios of individual securities, whether they include stocks and or bonds? What percentage of my portfolios should be allocated to stocks versus bonds? And should we add commodities to the mix as well? What are money market securities? Which bond ETFs should I choose to build the foundation of my investment portfolio? Where can I buy bond ETFs and stock ETFs so that I can implement bucket investment strategies like the anti-fragile investment approach? How do I set up a direct deposit investment program with my central checking account? What should I do with the monthly dividends and interest income that are generated by the investments in my brokerage accounts? What is bucket investing? And how should I approach investing in time segments, buckets A, B, and C? Do I need to have a bucket B, for example? Which buckets are relevant to the anti-fragile investment approach? How frequently should I rebalance my portfolios? Who can help me review my personal financial situation? And as promised, here's my free bonus for watching this video. It's the Bucket A Model A2, which is an ultra-safe bond ETF portfolio. Let's take a quick look, shall we? We've got 15% weighting to bond ETF SGOV, VGUS, TFLO, TFLO, and USFR. These are all Treasury bill bond ETFs, which have very short maturities. Next, we have a 12.5% weighting and a 10% weighting to actively managed short-term bond ETFs, which incorporate some treasuries, but mostly corporate bonds, short-term commercial paper, and investment-grade securitized loans. And finally, we have a 20% weighting to CLOs. These are collateralized loan obligations. As you could tell from the Janus JAAA, these are AAA rated collateralized loan obligations from highly rated companies across the country. And they pay a slightly higher yield than corporate commercial paper, for example. The little bit of turbo yield that you need to beat CDs, money markets, high yield savings accounts, and inflation. I like to think of these bond ETFs as liquid money market funds on steroids. Now, as far as the other bucket models that I cover in my bucket investment book, I have 3 suggested models for bucket B and 3 for bucket C. These models are designed with time segmenting in mind, so that you want the bucket A models to address short-term immediate expenses. Bucket B models are slightly more aggressive. They have a little bit of stock ETF exposure, and they address expenses and goals in the 2 to 7 year range. And finally, we have the bucket C models that are for goals that are greater than 7 years out into the future. So that may include saving for your retirement, for example, in a qualified retirement account like a Roth IRA, saving for a child's education, or for an endowment fund of some kind, legacy account. Bucket C is for financial goals like that. Again, these models are all available in the Bucket Investment book. I share with you the exact percentage weightings and the ETFs that comprise these bucket models. I also include a chapter on international investing as well, because I strongly believe that investors should have some international exposure in their overall mix. So sign up today at SmartInvestorModels.com. Drop me a line or comment or suggestion for subjects that I may be able to answer for everyone. And also visit us, like and subscribe to the Smart Investor Models YouTube channel. Thanks so much for watching, and I look forward to seeing you in the next video, where I'm going to talk about some of the key differences between stock ETF investing and bond ETF investing, And along the way, I'm going to talk about some of my more favorite ETFs that I think you may be interested in. And I hope to see you in the next video.